Welcome to another video of looking at the SRA's accounting rules governing your financial practices. It is essential to have a clear understanding of the guidelines to safeguard your reputation and your client's interest. Rule 2 covers client money in a great amount of detail, and today we'll be looking at the first two parts of Rule 2. The rule is broken down into 5 parts in total, and the last 3 we'll cover in the next video. So Rule 2.1 is the definition of client money. The rule states that client money is money held or received by you, A, relating to regulated services delivered by you to a client. So this is an example of where you would hold money in a conveyancing transaction. This is also money held, B, on behalf of a third party in relation to regulated services delivered by you, such as money held as agent, stakeholder, or held to the sender's order. And this is similar to the previous part, Part A, only this time it is held by you as a third party. Part C could be money held as a trustee or as the holder of a specified office or appointment, such as the donee of a power of attorney, court of protection deputy, or a trustee of an occupational pension scheme. And then Part D, and this is the big one, it could be money held in respect of your fees and any unpaid disbursements if held or received prior to delivery of a bill for the same. So here we are saying client money could be money that the client gives you on account of costs where the cost hasn't been incurred. Before you've done the work, you've kept the client money in the client account until the work has been properly billed and communicated to the client. The separation between client money kept in the client account and the business money kept in the firm's office account is reflected throughout Rule 2.1, and the emphasis here is of keeping the two separate until it is appropriate and past the other rules to transfer money across from client account to the office account. Rule 2.2 is holding client money in the office account. So this is quite contradictory to Rule 2.1. So this is the situation where client money can be held in the office account. This is a very strict rule and only applies to a very small number of firms. And this is basically when you are assessing and looking at if your firm should be holding client money in a client account. So the rule states, in circumstances where the only client money you hold or receive falls within Rule 2.1d, this is the above part where we have talked about the rule in respect of your fees of any unpaid disbursements. In that situation, and also any money held for disbursements relating to costs and expenses incurred by you on behalf of the client for which you are liable. So very specifically in this situation means that if you need to hold money, but the liability to pay for the disbursements have moved from the client to your firm is liable for paying those costs. And also you do not have any other reason to maintain a client account. This means if you do a firm-wide assessment and there's no reason to hold client money, it's not a matter-by-matter assessment. This should always be looked at firm-wide. Does the firm need to hold client money on account? Only if that's the situation, so where the liability to pay the disbursement has moved to the firm and there's no other reason to hold client money, and you have informed the client in advance where the money will be held, then money can be held in the office account. An example of this is where your firm's doing advisory work and you receive money in account of a retention payment to start the advice matter. And you'll be doing, this is not where you'll be doing anything like conveyancing or probate work where money is received and held on behalf of the client. It's only purely on advice work that you'll be doing. If this is the case and you do not keep client money on account at all, there are a number of rules that won't apply to your firm, 2 of which will be in the next video, which we'll talk about, and then a few more rules down the line, which we'll cover a little bit later. So this means the firm operates as a standard business, basically, without a client account, and there is no need for a client account audit, which would have been the case if the firm held client money in excess of the reporting thresholds. Firms cannot switch back and forth, flip-flopping between holding client money and not holding client money. There is obviously a lower admin burden when you follow Rule 2.2 and do not keep client money on account, but it's definitely worth thinking longer term if your firm is planning on holding client money at some point, that it would be worth setting up your systems, your processes correctly from the start to not incur those additional admin costs of changing down the line. So it's worth thinking about the future if you are likely to be holding client money on account, just to go the client money route from the word go. And that said, also Rule 2.2 probably won't apply to your firm, probably applies to a very small number of firms. Okay, so that concludes the video of our exploration into the SRA's accounting rules for Rule 2.1 and 2.2. So as you can see, Rule 2 already contains a lot of detail, and we'll be looking at the next 3 parts of Rule 2 in the next video. Remember, staying informed is key, and thanks for watching.